There is a second shadow American economy. Its balance sheet holds over $19 trillion. It earns hundreds of billions in profits each year. And by deliberate design, it exists almost entirely beyond U.S. borders. This is not a conspiracy theory. It is the logical, legal endpoint of decades of corporate strategy and international tax code. According to the U.S. Bureau of Economic Analysis, the total position of U.S. direct investment abroad reached a staggering $19.2 trillion in 2023. This figure represents wealth, physical factories, patented intellectual property, foreign subsidiaries, and stockpiled cash that is owned by American companies but is legally and financially resident offshore. This creates a profound cognitive dissonance. We measure the health of corporate America by the S&P 500, traded in New York. But the S&P 500's future growth, its critical research and development, and an ever larger share of its profits are increasingly being booked in low-tax jurisdictions like Dublin, Bermuda, and Singapore. The iconic American corporation is morphing into a financial and legal shell for a global profit-harvesting machine. Its heart, its capital, and its innovative capacity is no longer geographically American. This raises two alarming questions. How did $19 trillion, an amount equivalent to 70% of the entire U.S. GDP, legally exit the nation's economic sphere? And more critically, what happens to a country when the core assets of its most powerful companies are deliberately held beyond its reach? Its tax authority, and its economic multiplier effect. The story of this great corporate exodus begins not with simple corporate greed, but with a single pivotal change in the global rules of the game that made the world safe for stateless income. The architecture of the exodus was perfected in the early 2000s with a structure known as the double Irish, with a Dutch sandwich. This wasn't shady evasion, it was a meticulously legal labyrinth built on treaty gaps. Here's how it worked. A U.S. technology or pharmaceutical company would transfer its crown jewels, its patents, trademarks, and proprietary software to a newly created Irish subsidiary. This Irish entity would then license that intellectual property to a second subsidiary, often located in a zero-tax jurisdiction like Bermuda. The U.S. parent would pay hefty royalty fees to the Irish company for using its own IP, deducting these payments from its taxable American profits. The Irish firm would then pay matching royalties to the Bermuda mailbox, where the income vanished into a tax-free void. The profit was rendered stateless, earned from global sales, but legally belonging nowhere for tax purposes. The scale of this engineered migration was breathtaking. By 2015, Ireland's national accounts reported corporate profits larger than its entire gross domestic product, a statistical impossibility that exposed the sheer magnitude of profits being funneled through its borders. Similarly, tiny Bermuda, with a population of 60,000, became one of the planet's largest recorded hosts of foreign direct investment on paper. The enabling catalyst was the rise of the knowledge economy. You cannot physically pick up a steel mill or an auto plant and move it to a Caribbean island, but you can transfer the legal ownership of a billion-dollar drug patent or a critical search algorithm with a click and a notarized document. The most valuable assets of the 21st century, intellectual property, became its most geographically mobile. The global tax system, built for a world of tangible goods, was utterly unprepared for this intangible revolution. This financial plumbing was constructed in the quiet footnotes of annual reports. But in 2004, a single explosive SEC filing from a then-nascent company called Google would pull back the curtain, revealing to the world the staggering scale and audacity of the corporate exodus already underway. The $19 trillion offshore buildup was turbocharged by a critical accounting fiction, the concept of permanently reinvested foreign earnings. Under U.S. GAAP Rule ASC 740, a corporation could defer booking any U.S. tax liability on its foreign profits indefinitely, provided it made a formal pledge that those earnings were permanently invested outside the United States. This created a powerful, perverse incentive. To avoid an immediate accounting charge that would crush reported profits, companies had to vow never to bring the money home. Apple's pre-2018 financials are the canonical case study. By 2017, Apple held a staggering $252 billion in cash and marketable securities offshore, nearly all designated as permanently reinvested. This allowed it to report an effective global tax rate in the mid-teens. Buried in its annual report was a stark warning. Repatriation could trigger a one-time tax expense of approximately $36 billion. The accounting rule had turned a tax deferral into a seemingly permanent capital exile. The national economic impact was profound. To justify the permanent label, companies couldn't let the money sit idle. They actively deployed it, but overseas. They built state-of-the-art research centers in Ireland, acquired competitors in Europe and Asia, and expanded manufacturing networks across Southeast Asia. The accounting pledge became a self-fulfilling prophecy of disinvestment from the U.S. industrial base. Data from audit analytics reveals the staggering aggregate scale. The sum of permanently reinvested earnings disclosed by S&P 500 companies peaked at nearly $3 trillion in 2017. This was not dormant cash. It was active, growth-seeking capital systematically directed away from the American economy by the very accounting rules designed to clarify corporate health. The system had reached a breaking point of its own logic. Washington's response in 2017, however, would not mend the flaw. Instead, the Tax Cuts and Jobs Act would supercharge the next, more sophisticated phase of the corporate exodus. The 2017 Tax Cuts and Jobs Act was hailed as the solution to bring offshore wealth home. Its mechanism was a one-time repatriation tax on accumulated foreign earnings at discounted rates of 15.5% for cash and 8% for liquid assets. The result? Over $1 trillion flowed back on paper. But the Fed ES research shows most of this capital was immediately deployed for record stock buybacks and dividends, not for the promised boom in domestic factories or R&D. The first mission was a mirage. The Act's fatal flaw, however, was its new permanent international system. It attempted to balance a minimum tax on offshore profits, the global intangible low-taxed income, GILTI, at 10.5%, with a carrot, a lower effective tax rate for foreign-derived intangible income, FDII, designed to reward profits from exports and services sold abroad from the U.S. This created a powerful, perverse new incentive. To maximize the FDII benefit and minimize the GILTI hit, the optimal corporate strategy is not to simply report more U.S.-based export income. It is to physically shift the underlying high-value intangible assets and profit-generating activities themselves to foreign jurisdictions. As tax scholar Kimberly Clausing analyzed, the system effectively subsidizes moving operations offshore to then generate foreign-derived income. The law incentivizes the very exodus it purported to stop. The data, post-2017, confirms this structural failure. While announced stock buybacks soared, real domestic investment by U.S. multinational corporations stagnated relative to the size of the economy. Meanwhile, the outward flow of capital, U.S. direct investment abroad, continued its relentless trillion-dollar-per-year climb unimpeded. The 2017 Act did not end the corporate exodus. It merely changed its currency. The game is no longer about parking historical cash offshore. It is about strategically locating the future profit centers, the intellectual property, the high-margin manufacturing, and the global hubs outside the United States. The $19 trillion offshore position is not a parked car waiting to return. It is a growing, self-sustaining economic colony, nourished by the very U.S. tax code that was meant to reclaim it. This is no longer just a tax story. This engineered capital flight is now the primary driver of three existential crises metastasizing within America itself. The $19 trillion corporate exodus is not a passive accounting entry. It actively hollows out the U.S. economy through a self-reinforcing trilemma. First, the investment drought. When corporations deploy capital offshore, they build state-of-the-art factories, research labs, and regional headquarters there, not in Ohio or Michigan. This contributes to a persistent, decades-long decline in domestic, non-residential investment as a share of GDP. This investment is the seed corn of productivity growth, the primary driver of rising wages and living standards. By starving the domestic base of capital, the exodus directly undermines the engine of middle-class prosperity. Second, the erosion of the tax base. Profit shifting systematically reduces taxable corporate income in the United States. Consequently, federal corporate tax revenue as a percentage of GDP ranks among the lowest in the developed OECD world. This lost revenue exacerbates budget deficits, forcing cuts or underinvestment in the very public goods, infrastructure, basic scientific research, education that form the foundational platform for private sector innovation and competitiveness in the first place. Third, the IP and innovation migration. Research and development follows the legal ownership of intellectual property. As patents for blockbuster drugs and foundational algorithms are legally held in Irish or Singaporean subsidiaries, the high-value R&D to improve and iterate on those assets increasingly clusters in those jurisdictions or other global hubs. National Science Foundation data confirms a steady rise in the share of U.S.-funded business R&D performed overseas. America risks losing its grip on the generative cycle of innovation that built its technological dominance. These three crises feed each other in a vicious cycle. Less domestic investment lowers productivity and wages, which weakens domestic consumer demand. This, in turn, gives firms even more incentive to seek growth in faster-growing foreign markets, further incentivizing profit shifting and offshoring. The documented narrative of global corporate dominance masks the verified hollowing out of the domestic industrial and innovation base that sustains a nation. Faced with this trilemma, corporate America's leadership made a deliberate, rational choice for their shareholders. And the evidence of that choice is buried not in conspiracy, but in the dry footnotes of their quarterly financial reports. The $19 trillion exodus is not an accident. It is the output of a financial system working with perfect, ruthless logic. The governing doctrine since the 1980s is shareholder primacy, the belief that a corporation's sole purpose is to maximize shareholder value. Offshoring profits is a textbook method to achieve this, as it mechanically boosts earnings per share by lowering the effective tax rate, a direct, uncontroversial lift to the share price. This creates an inescapable mandate for management. A CFO can present a clear slide to the board. Strategy: go away. Keep a high-value R&D and IP in California, facing a combined 25-30% tax rate, yielding an after-tax return of 8%. Strategy B: legally transfer the IP to an Irish R&D center, facing an effective tax rate of 510%, yielding an after-tax return of 12%. Within the framework of fiduciary duty to shareholders, the choice is compulsory. It is not corruption, it is optimization. The 2010s inversion wave made this logic explicit. Companies like Burger King, Medtronic, and Johnson Controls executed multi-billion-dollar mergers specifically to re-domicile their legal headquarters to lower tax countries like Ireland and Canada. Their press releases and investor materials openly cited enhancing shareholder value through a more competitive global tax structure as a primary rationale for the deal. The repatriated offshore cash supercharges this engine. Post-2017, rather than funding domestic investment, hundreds of billions flowed into record stock buybacks, over $4 trillion from 2018 and 2023. Buybacks inflate EPS and consequently share prices. Since a massive portion of executive compensation is in stock awards and options, the C-suite has a direct personal financial incentive to perpetuate the cycle. Shift profits offshore to boost EPS use freed up cash for buybacks to further boost the share price and reap tens of millions in personal compensation. The loop is closed and self-reinforcing. The silence of the largest institutional shareholders, BlackRock, Vanguard, State Street, is deafening. As the dominant owners of the market via index funds, they are positioned as the ultimate stewards of long-term economic health. Yet, they have largely declined to use their voting power to challenge strategies that erode the domestic tax base and innovation ecosystem. Why? Because the short-term EPS lift from tax avoidance also boosts the net asset value of their passive funds. They are complicit through inaction, prioritizing immediate index performance over systemic sustainability. The contrast between the modern rhetoric of stakeholder capitalism and the verified reality of capital allocation, where tax efficiency trumps national economic interest, could not be starker. The system is working flawlessly for its immediate participants. This raises the final, stark question. Can this financial logic be altered, or is America's corporate wealth destined to permanently emigrate, leaving a hollowed-out shell for its citizens? The global policy response to this structural crisis arrived in 2021. The OECD S-Pillar 2 agreement, signed by 140 nations, establishing a 15% global minimum corporate tax for large multinationals. Its goal was elegant: remove the incentive for profit shifting by making tax havens irrelevant. In practice, it faces fatal flaws and maybe too little, too late. First, the carve-outs. The rules contain a substantial substance-based income exclusion, allowing companies to exempt 5 or 10% of the value of tangible assets and payroll from the minimum tax base. This means a genuine factory with workers in Ireland still enjoys a significantly lower effective tax rate than a mere IP holding company, preserving the incentive to locate real operations offshore. Second, the U.S. implementation problem. The United States has not passed legislation to conform its existing minimum tax, GILTI, to the OECD model. The systems differ in critical technicalities. This creates a maze of complexity, risks, leaving U.S. firms at a disadvantage, and opens new loopholes for savvy tax planners to exploit between the two regimes. Most critically, the horse has already bolted. The $19 trillion in offshore assets and the labyrinthine corporate structures to manage them are already built and operational. A 15% minimum tax does not force this capital home. It merely allows other countries to collect a bit more revenue from profits that will remain, legally and operationally, outside the United States. This reality reveals America's weak hand. The U.S. can no longer credibly threaten high unilateral corporate taxes. Capital is too mobile. The power dynamic has flipped. The threat is no longer that capital will leave. It's that the trillions already abroad will never return. This fundamentally undermines U.S. fiscal sovereignty. The likely outcome by 2026 is a continued stalemate. Minor technical tweaks to GILTI, no major reshoring legislation, and the offshore hoard growing to $22 or $23 trillion. The hollowing out continues, just at a slower, more institutionalized pace. The contrast between political promises to bring profits home and the verified intractability of global capital structures has never been wider. This isn't a policy failure. It's the logical outcome of a world where capital has no nationality, but people and governments still do. The $19 trillion exodus is not an anomaly. It is the inevitable result of 4 core principles governing modern global capital. Principle 1. Capital flows to its highest after-tax return. This is the iron law of finance. Sentiment, patriotism, and even long-term strategic interests are negligible rounding errors in corporate capital allocation models. If moving a patent to Ireland boosts the after-tax return on equity by 2 percentage points, the money will move, always. Principle 2. Intangibles. Decouple legal ownership from economic activity. A physical factory must be where the workers and machines are. An intangible asset, a patent, software code, a brand, trademark, can have its legal ownership assigned to a shell entity in Dublin with a filing fee, while the engineers who created it remain in Austin. This legal fiction, protected by centuries of property law, is the primary engine of profit shifting. The law recognizes the Irish entity as the owner, regardless of where value is actually created. Principle 3. Fiduciary duty is a one-way ratchet. Corporate law, as interpreted by courts for decades, establishes that a director's primary duty is to maximize shareholder value. When this duty conflicts with the interests of other stakeholders, domestic workers, the national treasury, community welfare, the legal compulsion is clear. Executives are not merely allowed to choose offshoring for tax efficiency. In many interpretations, they are required to. Principle 4. Globalization of capital. Globalization of governance. Financial flows, corporate structures, and legal ownership became seamlessly globalized in the 1990s and 2000s. The political and tax frameworks needed to govern this new reality remain stubbornly national, trapped in 20th century treaties and paralyzed by sovereignty disputes. We live and struggle in this gap. As former U.S. Treasury Secretary Lawrence Summers bluntly noted, companies exist to make money, not to serve countries. These principles now form the immutable landscape for every worker, investor, and policymaker. They also explain the most important and dangerously underreported strategic trend in global business today, a trend that is reversing a century of industrial development. The capital exodus has evolved from a tactical shift into a fundamental redesign of the corporate form itself. The modern parallels reveal a new, stateless model of corporate citizenship. The parallel, the Delaware of the world. In the 20th century, firms flocked to incorporate in Delaware for its predictable corporate law. In the 21st, they create global holding structures in jurisdictions like Ireland, Singapore, or the Netherlands for favorable international tax and treaty networks. The American corporation is increasingly just an administrative shell for a globally dispersed financial entity. The neutral headquarters. This is the logical end state. Consider Accenture, incorporated in Ireland, run by American executives with the bulk of its revenue, and clients in the United States, yet legally a non-U.S. company. Eaton and Liberty Global followed similar paths. These are not companies that left America. They are corporations that have legally unmoored themselves from any single nation state, choosing a neutral platform optimized for global capital movement. The exodus is complete when the legal entity fully separates from its country of origin. The SPAC startup blueprint. The model is now baked in from inception. Modern technology and biotech startups are born global. Their venture capital comes from international funds. Their intellectual property is often held in a separate legal entity from day one, prepped for future licensing. Their exit strategy, whether via SPAC merger or acquisition by a larger multinational, is designed to slot into a pre-existing optimized global tax structure. The exodus is no longer a middle-aged corporate decision. It is the default setting of 21st century business formation. This is the critical warning. This trend is not confined to legacy industrials. The next generation of transformative companies in artificial intelligence, genetic medicine, and new space are being architecturally designed for global profit, shifting from their very first funding round. The infrastructure for moving their future profits offshore is built before they have any profits at all. The $19 trillion parked offshore today will seem a modest precursor to the sums that will be legally resident elsewhere by 2034. The contrast is stark. The documented 20th century model of national corporate champions, invested in their home country's infrastructure, has been replaced by the verified 21st century model of the stateless corporate platform, loyal only to its global shareholder base. For the average American, this structural shift can feel abstract and distant. But its most severe consequences are about to hit home in the most personal way possible, through the steady erosion of the promise of a career. The $19 trillion exodus is not an accounting trick. It is the active, legally mandated relocation of America's future wealth-generating capacity offshore. As a nation, we are trading short-term stock market gains for long-term erosion of our domestic industrial and innovation commons. This creates the sovereign investor's dilemma. As an individual invested in an S&P 500 index fund, you are a passive beneficiary of this system. Your fund's value is inflated by the higher EPS from tax avoidance. But as a citizen, a worker, and a parent, you are a clear victim, facing underfunded public goods, stagnant wages from the investment drought, and a diminished economic future. You are, in effect, financially betting against your own civic and economic well-being. The paths forward are all fraught. Radical harmonization, a true loophole-free global tax cartel, is politically near impossible. Radical unilateralism, the U.S. imposing extreme penalties on profit shifting, risks accelerating the very capital flight it seeks to stop. The most likely is grudging acceptance. America resigns itself to a permanently shrunken corporate tax base, shifting the revenue burden to less mobile factors like land, consumption, and individual labor. The research by economists like Gabriel Zucman provides the final, stark insight. Approximately 40% of all multinational corporate profits are now shifted to tax havens. The United States, as the home to the world's most profitable multinationals, is the epicenter of this outflow. This is the defining economic story of our era, meticulously documented, yet hidden in plain sight within the spreadsheets of the Bureau of Economic Analysis. Therefore, the call to action is analytical. Look beyond the daily stock price. Open any major corporation's annual report and read Note 5, Income Taxes. Ask your political representatives not merely about the corporate tax rate, but about the corporate tax base and what they will do to make American profits mean something tangible within American borders again. Wealth isn't passively leaving America. It is being actively, deliberately moved, and we have $19 trillion worth of financial statements to prove it.